Hi everyone, I'm James Harte from littlefishfx.com and thank you for joining me for this week's Forex Education Hour. Now, in some recent sessions, we've taken a look at structural price patterns which occur due to the underlying order flow that drives price and the repeatable sequences that form from these moves. But in this session, we're going to take this idea a little further and look at some of the other types of patterns that we can see develop in the charts, specifically harmonic price patterns. So if you have any questions during the show, please just write them in the chat function and I'll stop periodically to answer them. Okay, so what do we mean when we say harmonic price patterns? Well, unlike the patterns that we've looked at previously, such as head and shoulders pattern and wedge patterns, harmonic patterns take into account not only naturally recurring price formations, but also Fibonacci analysis, focusing on the specific reciprocal relationships between various price swings. And it's precisely this combination of natural price movement, recurring patterns, and Fibonacci analysis that can make harmonic pattern trading such an effective method to use. So, as with the price action and patterns webinar, instead of just giving you quite a superficial overview of a host of different patterns, we are instead going to focus on just a few precise patterns and actually look at the mechanics of how you can trade them, considering also the advantages and disadvantages of this method of trading and analysis. So there are a few key structures that we're going to focus on. These are the Gartley pattern, the ABCD pattern, the butterfly pattern, and the one-to-one pattern. So let's take a look first of all at what is perhaps the definitive harmonic pattern, and that is of course the Gartley. Now, there are many traders who trade slight variations of this pattern, but for this session we're going to focus on what is typically defined as the ideal version of the pattern. And this is really key because unlike the structural patterns that we've looked at previously, harmonic patterns are identified using precise parameters, and as such each pattern essentially has a checklist of criteria that must be met in order to successfully identify the pattern. Okay, so the Gartley pattern looks like this. You can see here we have the bullish version for a bullish reversal higher and the bearish reversion for a bearish reversal lower. And essentially, the measurements and structure that define the pattern are as follows. So if we look at the bearish version, we need to first of all identify a drive in price, an initial drive in price, which gives us our XA leg. We're then looking for a corrective leg, the AB leg, which retraces to the 61.8% retracement of that initial XA move in price. So from this point here, we then retrace between the 38.2 and 88.6% retracement of this AB leg. From this point then, we then see one final push higher, which takes us all the way up into the D point completion of the pattern, which has confluence between the 127 and 1618 extension of the AB leg and the 78.6% retracement of that initial XA leg. So if we can identify a price structure that conforms to these measurements, then we can successfully identify a Gartley pattern and anticipate a reversal from the D point, which is the completion point of the pattern. So essentially the Gartley pattern is a corrective pattern whereby we're identifying that initial drive in price, a sustained directional move, and then a corrective move, an overlapping move higher, which represents an exhaustion at this point and a resumption of the initial move. So let's take a look at an example on the charts of this pattern to start to think about how we can actually trade it and build it into our analysis. Okay, so here we have an example of a Gartley pattern. And first of all, just to point out, as you might notice, you can see that this isn't actually an ideal Gartley pattern, okay? The measurements are very close, but they aren't actually ideal. But we're just going to use this to outline the pattern's parameters in this session, because ideal Gartleys are actually extremely hard to find. They're incredibly infrequent patterns. And so what you often find among a lot of traders who trade Gartley patterns is that they aren't as specific with their requirements and they trade a slight variation, but we'll come on to that shortly. Okay, so you can see here in this image that we have our initial drive in price, this bearish sell-off, which gives us our XA leg. We then have our corrective leg higher, the AB leg, and you can see this falls just short of the 61.8% retracement. So it comes ever so close to actually tagging that level, but it falls just short before retracing down, and you can see that we trace down nicely between the 38.2% retracement and 88.6% retracement of this AB leg before reversing higher and trading all the way up to the 127 extension of that AB leg, which coincides nicely with the 78.6% retracement of that XA leg. So this is a really good example of how this pattern can look on the charts, because obviously the diagram that we consulted initially was very neat and very straightforward, but you'll note that this is actually a lot messier and probably harder to define. And this can be a really big challenge for a lot of traders who are looking to trade patterns. And you really need to think about this and spend a good deal of time going through the charts and honing your pattern recognition ability, because whilst there will of course be times when the patterns present themselves really clearly, there will also be many times when the patterns are a little more hidden like this, and the price action can actually obscure the pattern. So if you're going to be working on harmonic patterns, you really do need to spend some time honing your pattern recognition ability. So once we've identified our pattern, what are we looking to do? How are we actually looking to trade this structure? So the bottom line of this pattern is that we're looking to trade a reversal from the D point. Now, as I've mentioned in previous sessions where we talked about trading a particular method, the way in which you actually enter really comes down to your personal preference, because what you will often find is that more aggressive traders will simply trade a level strike whereby they sell as price touches that 78.6% retracement and 127 extension level. And typically their stop loss will be a volatility based stop loss. So we'll see something like a 20-day ATR stop used above the actual entry level. Now, we might actually look to use the structure of the pattern itself to place our stop. So typically where we see this pattern present, we can often find a good high point here to put our stop above. So if we're getting short from this location here, the next key structural point is obviously this swing high point here. And so we'd be looking to put our stop above that level. Now, alternatively, there are traders who will look for price action confirmation at the level. So they'll look to identify reversal candles such as a pin bar or an engulfing bar at the level, like we discussed in the price action webinar. So depending on your particular entry methods, your actual entry is going to be somewhere around this D point, this completion point. And you can see here, this is actually a really good example of the different ways that you can look to enter these trades, because if you had simply gone ahead and traded a level strike at the level, you would have been in short. Alternatively, you can see we actually had a bearish pin bar at the level. So we actually got that price action confirmation, just giving you an idea of the different ways that you can go ahead and execute on these patterns. Now, once you've entered the trade, now there are different objectives that various harmonic traders will have when they're trading these patterns. But basically what we're looking for price to achieve from the reversal at the D point is a move back down to the A level. If we identify the XA leg as an initial drive in price, and this is the corrective period, we're looking for the D point to represent an exhaustion and a resumption of that initial move. So we're looking for price to trade all the way back down to that A level. Now, there is a particular area that you need to be mindful of when you're trading these patterns. And I'm sure that structured traders, or those of you who are in the support and resistance webinars, have already guessed it. But essentially, the broken high of this AB leg, so this zone here, this can be a really important pivot for this pattern, because a lot of times what we can actually see in the patterns that fail is that price will sell off from the D point, retest this broken high, but fail to break back under it, and will actually reverse and take off higher. So this is really a key zone that you need to be monitoring when you're trading this pattern. And essentially, you're using this as the line in the sand. So again, another alternative entry method is you could wait to enter on a break below that broken high. So a break back down below that resistance level to give you confirmation of the move. Now, as I mentioned earlier, ideal Gartleys are actually quite rare to find. And so generally, what the majority of harmonic traders are looking for is this typical corrective structure that completes into a key Fibonacci level and has confluence with an extension of the AB leg and the extension of the BC leg also. So, sorry, an extension of the AB leg with confluence between a symmetry move. So the length of the move from the AB leg looking to be the same as that from the C to D leg. So where we can identify this confluence between a symmetrical price move here into the extension of the AB leg into a key Fibonacci retracement point, then these are typically traded as Gartley patterns, although, as we just saw, they aren't defined as ideal Gartleys. So you can see here that the initial AB leg was almost exactly the same length as the CD leg. So once we had price trading higher from this C point, we could go ahead and clone this initial price move and project it from this C point, monitoring price as it trades up into that symmetrical location. And you can see here that we get good confluence between the symmetrical move here and the key Fibonacci levels. Now, this component of the Gartley, this idea of symmetry between the AB leg and the CD leg, has become very important to harmonic traders, and it's actually been separated out into its own harmonic pattern known as the ABCD pattern. So the ABCD pattern simply relies on the corrective structure of the Gartley that we were looking at, but it doesn't have to form as a correction to a dominant price swing. So there is no XA leg in this pattern. There is simply just the ABCD portion. Now the pattern can either form as a corrective pattern within a trend structure, or it can simply be a counter trend reversal pattern. So where we see the pattern forming to the downside like this, we're anticipating a bullish reversal. And where we see the pattern forming to the top side like this, we're anticipating a bearish reversal. Now, the key component of this pattern is that we see two drives in similar length, okay? Now, the correction from the AB leg, so the BC leg correction, needs to come between the 61.8 and 78.6% retracement of that initial AB leg. And then the CD leg needs to complete into either the 127% or the 1618% extension of that AB leg. So where the Gartley pattern considers the structure within the context of the initial drive, the ABCD pattern is focusing solely on this corrective structure itself, and it isn't looking for an initial drive. So here's an example of the pattern in the dollar CAD, and you can see now what I mean when I say that the pattern doesn't have to form as a corrective pattern, but can actually form as a reversal pattern. So you can see here that we have price selling off, making a series of lower lows and lower highs. Instead of price retracing higher and forming a bearish ABCD as a correction, we actually see price driving lower but forming a reversal ABCD pattern. So you can see here that we are able to map our two equal moves, so this symmetrical moves between the AB leg and the CD leg. And this move completes right down into the 127% extension of that initial AB leg. Okay, so we have price selling off, we get our initial AB leg, we get the correction back up, we trade down into the 127% extension, and we have confluence there with the symmetry move between the ABCD move. So this is a great example of this pattern in play, and you can see that from the reversal zone we get a nice correction higher all the way back up to the top of the BC leg. So when it comes to trading this pattern, again, we're simply looking to trade a reversal from the D point completion. So either trading the level as a level strike or again waiting for price action confirmation. We're looking to get in at the D point, targeting a move back up to the start of the pattern. Now, in terms of a stop loss, again, you can use a volatility-based stop loss, such as using the 20-day ATR. It's a little bit more tricky if you're looking to use structure, because where these patterns set up as a reversal pattern, so where they don't represent a correction within a trend, it can sometimes be a little bit difficult to identify a clear structural level that you can use for your stop loss placement. Now, in terms of a target, generally traders will aim for the top of the BC leg, so this point here, or holding for the very top of the pattern. Again, because this pattern is a reversal pattern, so it's typically counter trend, it can be a little bit tricky sometimes if you're looking to hold price all the way back up to the start of the pattern. And so another level that we'll often see harmonic traders targeting in this move is the symmetry move between this leg here, so the BC leg, and then the move from the D point completion. So essentially, you can see they'd be targeting a move of equal length from that BC leg correction. So this is an area that harmonic traders will be paying attention to as price trades up into that level for potential profit-taking zone. Now, in this slide, you can see that we have an example of the ABCD pattern as a corrective pattern, okay? So instead of price forming as a reversal pattern, you can see that we've actually got a correction within the initial bearish trend. So price is selling off with a series of lower lows and lower highs, and then we actually get a retracement higher that gives us our corrective ABCD pattern. So again, we get that initial correction from the BC leg back into the 78.6% retracement of the AB leg. We then clone this initial move, the AB leg, project it from the C point, and you can see that price trades all the way up into that level. And we get confluence there with the 127% extension of that initial AB leg. Okay, so this is obviously an example of trading the ABCD pattern within a trend structure. So instead of trading a counter trend reversal, this time we're trading with the trend. We've identified a correction within the trend, and we're getting in at what we anticipate will be the exhaustion point of this corrective move. So in this type of situation, we anticipate that there is probably better risk reward for the trade, because we anticipate we'll get a resumption of the trend and price is going to break down through lows. Now, when we're trading the counter trend version of the pattern, it can sometimes be a little bit more difficult to hold on to the trade and try and catch a move. Obviously, playing counter trend is a much higher risk scenario than trading with the trend. And generally, even where the trades do work out, what we typically see is that we'll only get a minor correction before the trend resumes. However, in this scenario here, where we're trading with the trend, we're getting in at the exhaustion point of the correction. And so we have momentum on our side, and we're anticipating a resumption of the trend. And if we zoom out on this pattern, you can see that's exactly what we saw. So price corrected higher. We got our ideal ABCD pattern. We got in at the exhaustion point, and you can see that we played for a resumption of the trend. So this is a really good example of how you can look to use these harmonic patterns to gain entry points to trending markets. And as I've said in previous sessions, you always want to be considering the location of the patterns you're trading, not just looking to trade every pattern that pops up, okay? And looking to trade with the trend is the best way to build a sustainable approach to trading. Now, we always also want to be looking to build a picture of confluence. And one of the reasons a lot of harmonic traders suffer, firstly, is because they trade every pattern that presents itself and they don't consider location. And secondly, it's because they just consider the pattern itself and they aren't looking for any further confirmation. So as we've looked at in previous webinars, looking to combine elements such as trend lines, support and resistance, etc., to identify areas of confluence will help us strengthen our case for taking a trade. Okay, so here we have a really great example of how we can use harmonic patterns as part of our analysis, combining them with traditional technical elements to identify confluence. So in this image, we can see that we had sterling yen traveling in a bearish trend structure here, forming lower lows rather, and lower highs. We then marked out this clear support level over this zone before breaking down below that support level. We traded lower to form new lows, and then you can see we corrected higher back up to retest those broken lows and to retest that bearish trend line. And you can see that the structure of the correction to that level actually gave us a really nice ABCD pattern. So here we had a clear example of the ABCD pattern that we were just looking at in confluence with broken structure, which we know can often lead to a resumption of the trend, and also our trend line resistance. So this is a really great way and shows how versatile harmonic patterns can be in terms of integrating them with other traditional technical analysis methods. And this image actually introduces us now to another really important harmonic structure, and that is the one-to-one pattern. So we've seen how symmetry is used so far within the Gartley and the ABCD patterns, where moves of equal length project forward to identify a reversal location. Well, the one-to-one pattern uses symmetry, but in a slightly different way. And this time it's to identify retracement of equal lengths, again, to identify a potential reversal location. So this is the one-to-one pattern, and you can see what I mean, whereby instead of having two swings that are projected of equal length moving forward, this time we're identifying two retracement swings of equal length. So the ideal measurements for this pattern are whereby we see the XA leg retrace, the AB leg retrace between 61.8 and 78.6% of the initial XA leg. And then the CD leg, which again must be equal to the length of the AB leg, retracing between 50% and 61.8% of that XC move. So not of the initial XA move, but of the whole move, from the low to the structure to the top of the structure. And then obviously for the bearish version, from the top of the structure to the bottom of the structure. Okay, so here we have a great example of the pattern in play, and this is one that formed recently in the euro yen. So you can see we got our initial XA leg here, a correction higher, giving us our BC leg. This came all the way back up to just shy of that 76.4% retracement level before we sold off, traded down, made new lows. And then from this point, you can see we got out another correction higher, and the correction actually came in perfectly equal length to that initial correction, so giving us the one-to-one move and into the 50% retracement of that X to C move, so from the top of the structure to the bottom of the structure. And so you can really see now just how powerful these patterns can be and how fantastic they can be in terms of getting you trend entry points. So obviously this is the 4-hour chart, so the reversal from this one-to-one was quite significant, 128 all the way back down to lows at 122. Now again, you can see that we have some nice structural confluence at this level where the pattern completes into the last minor swing high. So we've got a sort of mini double top there. And this is giving us another example of how we can combine harmonic patterns with more traditional technical analysis elements to identify key locations that we want to trade. So we've got the confluence of the symmetry between these two swings, the fib confluence at the key 50% retracement level, and then also a key structural point into these broken lows and this previous swing high. So in terms of how we actually trade this pattern, once more, we're simply looking for a reversal from the D point. Again, either trading a level strike or waiting for price action confirmation. And generally with this pattern, we're targeting a move back down to the low of the pattern, so the BC completion point. Now, in terms of stop loss placement, again, we're either beginning to be looking to use structure, if there is any. So in this instance, we might look to put our stop behind the most recent swing high, which is this point here, or again, using a volatility-based stop, such as using the 20-day ATR. Now, the one-to-one pattern is actually a pattern where we can look to identify harmonic confluence to further strengthen our case for trading the pattern. So just as we looked at in the Fibonacci analysis webinar, where we can look to identify different Fibonacci levels from various swings in confluence, we can actually look for different harmonic patterns completing at the same point to identify potential stronger candidates, location candidates for trading. And one of the best confluence patterns that we can get is where we get an ABCD pattern completing into the same location as a one-to-one. So essentially where we get an ABCD pattern in that final CD leg. So essentially what we're looking for is this dynamic, whereby we get an ABCD pattern that completes in the final CD leg of a larger one-to-one. And where we have these two patterns completing at the same level, this really increases the likelihood of the pattern producing an anticipated reversal. So if we take a look at this example, this is sterling dollar chart. This is the chart that we used earlier to illustrate corrective ABCD pattern. And you can actually see that whilst we do indeed have that ABCD pattern here with the symmetry move completing into the 127 extension of that AB leg, that ABCD pattern also completes into the CD leg of a larger one-to-one pattern. So you can see now when I talk about in terms of having internal ABCD pattern within the CD leg of a larger one-to-one. So where we can identify a confluence of patterns like this These are really great setups to look to trade. And again, we have the general trend direction on our side. Price is moving lower, making lower lows rather, lower highs, lower lows, lower highs. So we have our nice trend formation. We've identified a correction, and then we've identified confluence between two harmonic patterns. So again, in the same way that we can look to combine harmonic patterns with other technical elements such as trend lines, support and resistance, etc., we can also look to build confluence simply through identifying coincidental harmonic patterns. Now, the final structure that we're going to take a look at in the session is actually an adaptation of the Gartley pattern, sort of a mutant Gartley pattern, if you will. And that is the butterfly pattern. So the butterfly pattern looks like this. And you'll see now why I label it a sort of mutant Gartley pattern, because the structure is similar, but it has some key differences. So the basis of this pattern, if we look at the bullish version, is that we have an initial XA move in price, a correction higher, which completes into the 78.6% retracement of the XA leg, followed by a retracement lower between the 38.2 and 88.6% retracement of the AB leg, and then one final push higher that actually eclipses the high of the initial XA leg. So moves beyond that high point and completes into either the 127% or 161.8% extension of that XA leg, where we must also identify confluence with the 161.8% or 261.8% extension of the BC leg. So 2 points of extension confluence have to be identified into the D point completion of the pattern. So here we have a great example of a butterfly pattern in play. You can see we have our initial XA leg here, this bearish swing. We get our retracement higher into the 76.4% rather retracement of that XA leg. We then retrace lower all the way down into the 61.8% retracement of the AB leg. Then finally, we get that last drive higher right up into the 127% extension of the XA leg, which also has the 161.8% extension of the BC leg right in that zone too. So you can see here how we've identified the confluence of these key Fibonacci measurements, and price traded all the way up into that zone before collapsing lower. And again, in terms of trading this pattern, either looking to trade a strike of the zone or identifying price action confirmation. And once again, just as we've seen in some of these other patterns, we've actually got price action confirmation by way of this bearish pin bar. And this is actually a dynamic that you'll see occur a lot of times, because these zones tend to be such powerful reversal zones. The candle that trades up and touches this zone will often see quite a sharp reversal. And so you will generally tend to find that you get these pin bar candlesticks or engulfing candlesticks forming from these level strikes. So if you are a trader who likes to wait for price action confirmation, then price action confirmation works very well with harmonic patterns. So if you think about the dynamic of the butterfly pattern and what's actually happening, you can see how the completion of the pattern represents a capitulation in the price action. So we get this initial drive higher, which is rebuffed. Price sells off, tries to make a return to that high, but fails, trades lower, stalls out at this point, then tries to make one final push. And here we get that exhaustive move to the upside. We run those highs, clear out the stops above those levels. We actually sucker in some breakout longs who are probably taking positions on the breakout above that high before price reverses and collapses lower. So typically this is a pattern that occurs in line with a good stop run, where we get the lower high, which sees short starting to build. We then blow up through those highs and, as I say, clear the stops, sucker in some breakout longs before reversing. Now again, considering the location of this pattern is key. Where we see this pattern occur at the top of a corrective structure within a clear trend, then this capitulation can be a great telltale sign that the correction is now exhausted, and we're likely to see a resumption of the trend. And if you can zoom out here, you can see again, that's what we saw. So price was selling off we had a nice correction within this bearish trend. We got a butterfly pattern, which represents a capitulation, so an exhaustion of the corrective move, and then price reversed and sold off again. So again, in terms of how we trade this pattern, if we go back to a close-up version, once more, we're simply looking to trade a reversal from the D point. So that's the common theme with all of these harmonic patterns, is that we're looking to trade a reversal from the D point. So in this instance, we're looking to sell from the D point, and our target is typically the XA leg of the structure. Now, again, as I say, you have to consider the location, because where, as in this instance, we see the pattern form at the completion of a corrective period within a dominant trend, then we can anticipate probably a much larger resumption of that trend. And so we might look to hold below that XA leg. But in terms of just trading the pattern itself, typically if we sell the D point, our initial target at least is going to be a move back down into the bottom of that structure. Again, in terms of thinking about sticking points on this pattern, well, this XA leg high represents the price pivot that we really need to see broken to confirm the trade. So if the trade is going to fail, this is typically the area where it fails, or deeper down at the retest of the BC leg. So again, structure traders, these highs represent clear broken resistance, which now potentially offer support. And so we want to monitor price as it returns to retest these broken highs, because if price is going to fail and move higher, these are generally going to be the areas where we're going to get buyers stepping back in. Now, again, we can look to use our other areas of technical analysis for strengthening the case for trading a specific pattern, okay? So don't just trade it because it shows up, because it's there. We want to identify confluence rather, between other elements. So in this instance, you can see that we had retraced all the way back up to a retest of these last broken highs. So again, going back to this, what we talked about in the support and resistance webinars, and the underlying order flow dynamic that creates and perpetuates these levels, we know that the demand that was strong enough to hold up this bearish trend and keep price supported now is overwhelmed by supply. And so if price trades back up to retest these broken prior lows, we know there's likely to be a lot of supply still in the market, and this is a good location for us to try shorts. And so where we can identify a harmonic pattern completing into an area such as this, then this strengthens our case for getting involved at that level and playing for a resumption of the trend. So hopefully by now you've got a clear idea of the sorts of opportunities that harmonic patterns can help you identify in the market, and the way that you can combine them with other elements of technical analysis to identify areas of interest. Now, finally, I thought we'd just consider for a moment some of the pros and cons of using harmonic patterns. Now, we talked about these really as we've gone along, but just to sum them up so you've got a clear idea in your head, because instead of just considering the advantages of the level, it really pays to always ground your study and research in reality, okay? You aren't doing yourself any favors by just focusing on the positives of a particular method or strategy. You need to also consider the limitations and the problems with the method to see if you're able to work with it, to see if there are any ways you can mitigate against the negative aspects, or indeed to see if you should be using this method at all, or if you should be focusing your attentions elsewhere. So it's always good to do that whenever you're learning about a new method or learning a new strategy, or even looking at indicators, to always be thinking about the pros and cons and the different ways in which you're actually going to put this stuff into work in real life trading. So in terms of the cons then, or the disadvantages, one of the big problems that a lot of harmonic traders face is that they're simply looking to trade each pattern as it presents itself. And unless you've done some serious back testing and have some really hard stats on every pattern that forms, this is something that you really need to avoid, okay? And as I said throughout the session, you want to always be looking to consider the location to improve your chances. So are you with the trend or are you against the trend? Is momentum on your side? Are there any clear structural obstacles that could prevent the pattern from working? So you always want to be really analyzing your locations and looking for the best locations. And really this comes down to building your patience, because you're going to need to wait for price to move into these key locations that you're looking to trade. And sometimes you'll get a pattern set up and sometimes you won't. But where you can wait for price to move into these key locations and identify the confluence of the harmonic patterns, this is going to increase the likelihood of your success with these patterns. Now, another big problem that people find comes down to the fact that these patterns are built on reciprocal relationships between various swing measurements. So some traders get frustrated by the lack of ideal setups. So such as we saw with the Gartley, where ideal versions of the Gartley are very rare. Traders will then start trading subpar versions of the pattern. And you might find that you end up struggling because they don't experience the same sort of success. So in this instance, you have two choices really. Either you can focus on a different pattern, or you can accept the infrequency of the pattern you're trading. So we've seen how the ideal Gartley can be quite rare, but we've looked also at a different version, so an ABCD pattern, which is far more common and extremely close in terms of being an ideal Gartley. So where you get an ABCD pattern completing into the 61.8% or 78.6% retracement of an initial move, then you've essentially got a Gartley pattern there. And finally, the actual trading of harmonics can sometimes present an issue for some people who get confused about whether they should be trading the pattern in terms of a level strike or waiting for price action confirmation. Well, this is the same issue that's going to present itself no matter what technical structure you're trading. And really, my best suggestion is that you spend some time working through the charts, back testing and doing your studying, looking to figure out how best to make the different patterns work for you. Okay, so many different factors come into play that it really makes it impossible to give a sort of one size fits all answer. We have different patterns, different time frames, patterns with added pattern confluence, patterns without. It comes down to whether you're swing trading the patterns or scalping them, whether they're trend or counter trend, etc. So there are lots of different issues to consider. So it really isn't as simple as me saying which one I think is best. And as I said, lots of times it really comes down to you putting in your own work and learning what works best for you and how to operate. Now that said, there are many great upsides to trading harmonic patterns. So the fact that we're relying on these really specific measurements means that harmonic patterns are actually quite easy to systemize, which helps remove the discretionary element, which can be so brutal for so many manual traders, and especially new traders who often find themselves crippled with indecisiveness. So they get a setup that develops and they're not sure whether or not they should be taking it. Well, harmonic patterns are simple because we have these specific criteria that need to be met. You simply have a checklist. If the criteria are met, then you take the setup. If the criteria aren't met, then there is no setup. So that is one great benefit. Harmonic patterns are very clear in terms of the specific criteria for the setup, allowing you to systemize them. Another big benefit to harmonic patterns is that there can be great ways to find unique entry points to trades and looking at the markets in a different way, because you'll often find that a lot of harmonic trading goes against some of the traditional technical analysis, such as we saw with the butterfly pattern, where we're essentially fading a move. So we're trading a reversal when typically we might be looking at a breakout over a new high. But these can be powerful opportunities. So at the very least, it's a good way to broaden your analysis and consider different opportunities. And finally, harmonic patterns, as we saw, as we looked at, can be extremely versatile and integrate really well with other technical elements when we're looking to build confluence. So we looked at in the example earlier where we can combine harmonic patterns with structural analysis and trend line analysis. And when it comes to the actual execution, using an element such as candlestick patterns works really well. So like we saw when we identified pin bars at harmonic pattern completion points to signal a potential reversal. Now, this idea of symmetry in the market, again, is extremely prevalent throughout the market's history. And if you go through any charts tracking the size of swings, you'll tend to find a great deal of symmetry between moves, which can be exploited once you learn to understand what it is that you're looking at and how you can use it. So again, this comes down to spending time going through the charts and working on parameters that you can use to operate these patterns. Okay, so I hope you've enjoyed this session. As ever, we've covered a lot here, and I look forward to catching you all next week when we'll actually do some live analysis of the charts. So some of the different technical elements that we've been looking at in these sessions, we'll actually look at the charts live and talk about how we can apply these elements in real time. In the meantime, please head over to the website. You can check out all of the great free education material we've got there, as well as the Forex Master course and our trade alerts. Our trade alerts are in their 7 month now. We've done over 3,000 pips with 7 winning months. And we've actually got a coupon here as a thank you for attending the webinar, which will give you 10% off the trade alerts. Okay, so thanks a lot, everyone, and I'll catch you again next week.